Hey guys, this is Israel, and I'm back. And again, you know this is Israel Keys Wealth Academy because you're enrolled in the Israel Keys Wealth Academy. In the last mentorship session, we looked at the we started looking at the concept of the fact that there are three major market conditions that govern the marketplace in any currency pair, any asset class, whatever it is. We have a consolidation market condition, we have a reversal market condition, we have a trending market condition. These are the three major ones. Each of them has at least the reversal and the trending have, especially the trending has two subsets of it. And we spoke about the fact that before you just start applying trades, and especially I should have said this in the last session, the concept of strategies is way overrated because strategies are designed by nature, good strategies, to function in one, maybe two market conditions. They definitely need the context of a market condition. And so if you jump into a trade without having understood the market condition you're in and just apply your strategy willy-nilly, it will lose sometimes when you could have avoided a loss or you could have won. And that is something that you want to keep in mind because it's very, very, very important. So with that being said, let's we looked at consolidation market conditions in our last session. Let's look at reversal market conditions, and I'm going to do reversals before trending because there's some concepts of the reversal market condition that we need to understand in the trending market condition. So while we spoke, I'm just going to, again, I'm using the weekly as my basis just because it will bring us down to a 4-hour, which most traders will use, whether you're a swing trader, a position trader, or a scalper. You're going to be using the 4-hour either to get your reference levels if you're a scalper or intraday or intra-week, or to get your entries if you're a swinger position. And of course, we know that every 4-hour divider is a 1-week candle. The same way every 1-hour or 15-minute divider is a 1-day candle. But this applies, you can use any time frames. Whichever time frame you start from, just work your way down. The principles are the same. This refers to what we spoke about when we describe price as a fractal. Price being a fractal means that no matter how many times you divide it down, it'll still look or behave the same way at different levels. So while a consolidation market condition is one in which price is being kept, for instance, here, I'm using the AU Aussie dollar pair within a clearly defined range. So that's a consolidation. And they usually tend to form either at the beginnings or the ends of certain periods of days, weeks, months, years, whatever. With the reversal, let me show you an example of a reversal market condition. This here is a reversal market condition. Now, you may say, well, it looks like a consolidation because price is being kept in the same range. Yes and no. And this is why. Let me show you this. So they can start off looking the same. But as the name suggests, a reversal market condition is one in which there is a clear change in direction or directional bias at that level. So let me put that in red because, again, you know my color scheme by now. Red is for the weekly, not orange red, danger red. There we go. And so at this point, price reverses sharply. It's going one way, it runs into resistance, and it comes back down. Now, if we knew every time price was going to reverse, we'd be millionaires, wouldn't we? We can't know for sure. Can we have very well-defined guesses? Yes. For example, I've shown you this several times before. The best prediction of future market behavior is previous market behavior, especially where liquidity profiles are concerned. So this is an old low from 2015, old high, sorry, from 2015. If we just draw a level there, no, that's not what I want. I want this. If we just draw a level there, we can see that we could reasonably expect that in this region here, price would reverse. Now, does it necessarily have to touch it to the pip, especially in your weekly level? No. But if you're trading again, just forget the fact that this is a weekly time frame. Any time frame, you throw that in there, you expect something to happen here, either for price to react to it and reverse, or it could continue. So it could have gone this way. Let me show you this. Price could have reached there, right? Come back here, gone up here. This is very common. Come back to test that level. Well, not to test it, just come back to that level and then gone on. That happens several times in the marketplace. So how do we apply the same general concept we spoke about, understanding what happens in a consolidation pattern? Now, again, we're going to go from the weekly down to the 4 hour. Again, you can use this for any of the time frame pairings, daily to 1 hour 15 minutes, monthly to daily 1 hour 15 minutes to 5 or 1 minute, whatever it is. So this is where we start to deal with some of the phrases that you guys have heard. Now, I'm going to zoom this out for a second. Okay, so I did the previous one. Let's see. Okay, right. So I'm going to take this off for a second just to make this clear, because I really need you guys to get this. This is perhaps the most, because there are elements of the reversal market condition which apply to the other two. For instance, we looked at in trading the consolidation one, that you still needed to have an idea of when and how to understand the reversals within the consolidations. But this is how reversals work. And I'm going to refer you to the mentorship session on market structure. But I'm just going to repeat a few things real quickly. So in the marketplace, we have something we refer to as market structure. Let me go to a daily chart or 4 hour chart actually to show this. So market structure, I'm going to take away the dividers. What we mean when we say market structure is the general way the markets move. We spoke about this in the Forex Basics series as well. So the trend consolidation, the trend market condition, which we will look at next, talks about the way the market moves. It makes highs, lows, highs, lows, highs, lows. It doesn't move up in a straight line. So for instance, between here and here, you could call this a swing of the market. That's one swing. And that's another swing down, right? So in this section here, it was primarily going up. So this is what we would refer to as a trending market condition. It's going up there. And in this section, it is coming down. So this would be an upward trend here. Just put that in there real quick, because I need you guys to really get this. So I'm going to annotate my chart as I go along. That would be an upward trend or swing. And this would be a downward trend or swing. So upward, downward. There we go. But even as we move, generally up and generally down, you see that the market makes short-term retracement. So in that swing there, that is what we call an expansion leg, referred to the Beyond the Basic series. And that's a retracement. Expansion is in the general direction of the overall swing, overall trend. Retracement is the counter swing, which is usually a lot smaller. Think of it as the market breathing. And what is happening here is liquidity is driving it in one direction. It's meeting opposing liquidity, and the running out of orders and people taking profits, so pulling their money out of the move, it then retraces a little bit till it finds an area. In essence, it's going up. People start to think that's a good price to sell. Price is more expensive than it should be on average. When the retracement happens and people take their profits or liquidity comes out the market, it finds a new support here based on the fact that people now think, based on this move, this is now roughly a good price. In essence, price is cheaper here than it should be. Let's jump in again. And the same thing occurs. And if you look at this on your charts yourself, you'll see that these usually follow Fibonacci numbers roughly. We'll do a mentorship session on Fibonacci on its own. And so there's several ups and downs that go into that move there. And if you broke it down to a slower time frame, you would see even more swings. Let's look at a 1 hour time frame. You would see even more expansions and retracements. Let's see. Where were we there? So 10th of January. So let's go. Okay, there we go. So if you looked at it on the 1 hour chart, you'd see that the way even more you could draw. So on a 1 hour chart, this now becomes on its own a swing or a trend, and it has its own smaller expansions and retracements, which is why we teach you to trade in combinations of time frames, because once you form trade ideas on a bigger time frame, the smaller time frames give you the opportunity to get better entries and exits and catch more risk to reward based on the refinements of the smaller swings that happen on them. So you see that there, the more refined swings, and you could go on, and I'm sure by now you get the point. Let me just finish this off for the sake of completion. I can be semi-OCD sometimes. And there you go. Actually, that doesn't finish it off. So since I've come too far now, I'm in for a penny. I have to be in for a pound. There you go. So that's the general way the markets move. Now, I'm going to keep that in there and take this off so that I can show you this in more detail. Now, the general coming up and down, up and down, up and down gives rise to something we call market structure. So market structure would suggest, in fact, let me go back in time so that I can see something that has already completed a profile. There we go. Perfect. So in this section here, price is generically going down, right? And as you can see, it's forming higher highs and higher lows. Now, it starts with something we call a market structure break. Market structure is the concept of the market making higher highs and higher lows, or lower lows and lower highs, depending on what direction price is going, up or down. A market structure break is when that cadence is reversed, but we'll come back to that in a second. So here, price makes a lower low, then a lower high, then a lower low, then a lower high, then a lower low, then a lower high, a lower low, a lower high. And so you can see it's generally coming down, right? It gets to this point here, and something changes. This is the first sign of the change. So price makes a lower low here, right? Which would be expected. You then expect it to make a lower high and carry on going down, but it doesn't. It flips. It makes a lower low, and then it violates that high and makes a higher high. This here is what we call a market structure break. because it's broken the structure of the market so far. Now, sometimes that could be a fake out, and then it comes and makes another lower low and continues going down. In Israel Keys Wealth Academy, we refer to that as an unsubstantiated or an unconfirmed. So, unsubstantiated or unconfirmed market structure break. MSB refers to market structure break in our terminology. So unconfirmed or unsubstantiated market structure break. That spelling is horrible. Let me fix that. Unsubstantiated or unconfirmed market structure break. There we go. Now, this here is an example of a substantiated or a confirmed market structure break. And it becomes substantiated or confirmed at the point where it forms a new form of market structure the other way. So that's a higher low, the higher high. It's confirmed or substantiated at the point at which it then makes a higher low. So it's giving you a higher high, it's giving you a higher low. At this point, we then expect the market to begin to rise. And what do you know? It does rise. And it starts to give us a new series of higher lows, of higher highs and higher lows. And so there's a new market structure here. It's now high, higher high, higher low, higher high, higher low, higher high, higher low. And then it goes. This point here, the market structure break, is a very important, it is by far, in my opinion, the most important concept in trading. If you don't understand this, you are not likely to succeed as a trader. And what, for instance, let me show you this in real time. What you have been duped to think, let me take this off now. What you have been duped to think of in your previous trading life as a trend line break, right, is simply a confirmed market structure break. That's it. Look at this. So this is the situation. So that's a trend line, right? Which are a taboo in Israel Keys Wealth Academy. If we catch you drawing trend lines, you're in trouble, except you're drawing them to see what retail is doing so you can think like a market maker. But if you trade trend line breaks, you're setting yourself up. But that's it there. So this is the kind of trend line break that works. See, supposedly price breaks the trend line, then it comes down and retests the line, right? No. Horizontal lines don't drive the market. Vertical lines do. Price levels and points in time. That's all. This was the high, the previous high in the market structure, the last high that was formed. When price violated that line to market structure break, it comes back down and forms a higher low, higher than this one here. At that point, we now know that price has reversed. And this is what the reversal market condition really is. Now, there are examples of unsubstantiated market structure breaks. Let me see if I can find one on this chart to show you. Let's see. So, let's see. Which one should I use? I can see a couple. Which one should I use? So there's one right here. Look at this. This is a market structure break, right? Price is going higher, high, higher, low, higher, high, higher, low, higher, high, higher, low. It then makes a lower low. That's a market structure break. If it had confirmed by making a lower high and then kept going south, it would have been a substantiated or confirmed market structure break. Unfortunately, it doesn't. This is what we call a fake out. So it just came there to clean liquidity. That's a liquidity run there. One of my mentors will call that a turtle soup. But that's a liquidity run there. In essence, it's dipping to take out the orders of this people, and then it keeps going the other way. So in essence, the move and all trends start that way. But sometimes it happens mid-trend because the liquidity that was engineered in the trend has dried out. So mid-trend, they need to do it again to throw some more pep into the step, because everybody here thinks it's coming down. They start placing sell orders. The market maker can buy. Or those who guessed right here, because they bought, their stop loss is a sell. If their stop loss gets triggered, it becomes a sell. The market maker can buy, and we go. But let's go back here. So that's the reversal profile. Now, what you see as a confirmed market structure break on one time frame sometimes is an engulfing on another. So let's come here. Just ignore the jumbled writings. You see that this is the point at which the market structure break happened. And what do you know? It was the point at which price exploded past the daily range of the previous daily candle. So this here is a valid engulfing if you're an advanced trader. If you're a beginner trader, the simple way to look at it is the last down candle. When price closes above the last down candle, that would be, get this to settle out, cool, which would be here. That's the last down candle. Either way is fine, because at this point, you would then wait for price to come back down into that level anyway, and then react. But this is the real engulfing here, because, let me make this a bit bigger. That's the real engulfing there, because that's the point at which a previous daily range price closed on the next day above the previous daily range. And what do you know? That was the market structure break level as well. So what you see as an engulfing pattern on a larger time frame is actually the market structure break on a lower time frame. And like I told you, market makers are really looking at monthly, weekly, and dailies, and sometimes the 4 hours, which is why the daily engulfing is a powerful sign. Because as we'll see with trendings, when the market gets in sync in a trend on a daily and above, it tends to stay that way for a little while. It very rarely fakes you out multiple ways. And so if we saw this, whichever one, so let's take that away for now. If you're an experienced trader, you would have recognized that as the daily engulfing. You are then waiting for price to come back down into that level there. If you're an unexperienced trader, which is fine, everybody starts from somewhere, that would be the safe, quote unquote, engulfing, in which case you then wait for price to come back down. The problem is you wouldn't know at what point to expect it to find support, in which case you would then drop to a 4-hour chart and you would find the market structure break on a 4-hour chart, which was here. Remember, that is the point at which this market broke structure. And you wait for the confirmation by the formation of a higher low. And at this point, the reversal is confirmed. You are now good to go. Right? Again, how do you trade this? You drop down to a lower time frame. So with the 4-hour, you go to an hour, 15-minute. I'm going to go to 15-minute. I think it's just generally wise to drop down 2 time frames to get the real benefit of it. So we're going to put this line here. So this is the day that this happened, right? Drop down to a 15-minute time frame. Let's see, what day was that? That was, it was the 10th of October last year. So let's drop down to 15-minute time frame and find the 10th of October. 10th of October. There we go. So that's the line there. Now I've gone past it. 10th of October. There we go. So you can see that that was setting up for a long time. That was the original last high, lower high. This was the low. This is the point at which price broke structure. Let's put the dividers, as you can see, this happened over several days. This is why you need to learn to be patient when you're trading the market, if you want high probability. So now, could you have jumped in here? Yes, and you would have made money, but then it would have started to come down. So you could have scalped this. But if you're trading off, that's why you need, remember, we said this at the beginning, you need to ask yourself, what's my reference time frame? Anything I do on the lower time frame is simply to refine that analysis. Everything I do on a higher time frame is to give me confirmation bias. But what am I trading? So I could be entering on a 15-minute time frame, but I need to remember I am actually trading the 4-hour. And so it breaks structure there. This is the point at which the daily engulfing would have been in place. So let's change that line to green, because that was the daily line from when the classical engulfing happened of the daily. This is the experienced level traders engulfing, but it's also the market structure break level. And then we wait for price to come back down. And so the break happened on the 3rd of October, which was, let's see. So what day of the week was the 3rd of October? Let me check my phone's calendar. The 3rd of October, 2019 was a Thursday. So it happened on a Thursday. So you'd have waited Friday the next week, overnight. Then Monday, the week, Friday that week, overnight. Monday that week. Tuesday that week. Wednesday that week. And Thursday morning. So literally a whole week later. A whole week later, overnight, coming into the London session, it would have come back to that level. Look at that there. And then what we teach you to do, you see how this works. So you don't just, oh, it's London. No, this is how it works now, because you understood you're on a reversal profile, reversal condition, sorry. Look how it lines up perfectly. So this is overnight. This is Asia. Let me put the, actually, no, I don't, because I take over. So this is Asia. This is the Asian range, right? Well, that's, first of all, the overnight range, and then that's the Asian range. And so price comes out of there a week later, revisits the same level, finds a reaction there. And so what are we taught? On a day you expect price to go up, you first wait for it to come down. Down to where? No, not you. Down into a predefined level that has already been delineated from several days ago, in this case, an entire week ago. So this level from an entire week, I'm just talking about that, just use the crosshair. So price goes down, finds support there, and look at what happens. It explodes, right? It absolutely explodes. Look at that in one 15-minute candle. And what time of the day did this happen? I can bet what time it is. In the London Open session that happened at, actually, no, this would not have been London Open. No, this is why. Because the Australian dollar, remember, is an Asian pair in that it has the Aussie dollar in it. And so during the Asian session, Australia was open, and therefore these, remember I said you trade pairs primarily in the hours in which at least one of the two different currencies in there is trading. So this would have been a valid move in the Aussie dollar because it was doing the Australian, which is an Asian session pair. And so it explodes. It finds, it coagulates around that daily engulfing level. So if you missed this here, because you were sleeping doing Asia. Well, when does this happen? This happens during New York, when the other side of the pair, the US dollar, is there. And that's, yep. So this would be 16:30 on this chart would be 2:30 in the afternoon, or 1:30. So 1:30 in the afternoon, UK time, because this server chart is 2 or 3 hours ahead. And so doing New York Open, like we teach you, you would have had an entry, consolidation around that line, an expansion. Well, first of all, consolidation, manipulation, an expansion, a retracement, and support. So you could have gotten in here doing Asia. This is why I don't like to trade these pairs, because you can miss some of the moves during the night. That's why I stick to pairs that are purely European or American pairs. But if you trade Asia, if you're awake at that time, you can get some good moves. And then what happens? Price begins to run. And the next day, if you missed that day, or you waited for that day to engulf fully, well, come the next day, what happens? Price opens, it drops down. Remember, it's an Asian pair, so it can do this over Asia. It drops down. Where does it drop down to? Into a level from a previous day. Look at that. That's the difference of that is the spread, or less than the spread. That's less than a pips difference. That's what we say. So that's the one exactly, 0.9 pips. That's why we say incorporate the spread. The spread, as you can see here, is roughly 0.9 pips on this pair. So that's perfect price action there, bang. And then it goes. But the entire setup of this trade, and of course, you go back, if you go back to, so the 1 hour chart, this is what it looks like. There we go. So this entire trade here, from here, with a stop loss of 10 pips and a take profit of 90 pips. So that's a 9-to-1 trade that unfolded over 2 days, was framed entirely on understanding that in a 4-hour chart, we were in a reversal condition. And so you see that the rules we're applying are different in this condition from what we looked at in the consolidation condition. So you need to understand what's going on. Now let's look at this even further, because that trade hasn't finished paying. I always say, when you catch a trade, you catch a tiger by the tail. Don't let it go till it finishes paying you. So this was the first entry, and you got that there. How would you know to get out? Well, depending on what level you're trading, if you're trading the 1 hour charts and below, there's a market structure break in the other direction there. Now, my 1 hour chart level color is blue. So there's a market structure break in the opposite direction. Did we know it was going to keep going up because it's a 4 hour? Yes. Look, this happened on a 4 hour. We expect it to go. We expect it. And where do we expect it to go? To a previous level of liquidity. What's the previous swing 4 hour high? It's this one here. Look, this is the previous. Let me put a horizontal line there. So that's the previous. Put that in purple, 4 hour. That's the previous swing high, overall swing high. The previous big picture swing high on a 4 hour chart. So we expect price to at least get there, maybe further. So if we're getting in here, if you're trading just in the 4 hour, that could be your stop loss 16 pips, or you could go all the way back down here, 48 pips again on a 4 hour chart. That's not horrible, and you would have at least 4-to-1, roughly 4-to-1, exactly 4-to-1, and it eventually gave about 5-to-1. But this is the beauty of using multiple time frames. You drop down to a 1 hour 15-minute chart. Let's use a 1 hour for this one to keep it conservative, because a 15-minute chart would have given you even more refinement and even more profit. Just say, hey, that's a market structure break the other way. So get out there. Look, let's get out there. That's still, let's see. 9 pips, 70 pips. That's 9 times 9 is 9 times 7, 9, 81. 9 with another 9. That's roughly 7-1 over 2 days. Why are you being greedy? Just take the profit and get out, because see what happens here. It breaks market structure, comes back up, breaks it again, and confirms it. So at least by this point, just get out. And what do? You wait for what? The next sync movement on the 4-hour chart. So you go to the 4-hour chart, right? Remember, this was the origination of the move there. So that's the new market structure until it breaks. Don't wait for it to break market structure on the chart you're on. That happens here. You will have lost more money. And just wait for it to come back down. Come back down to where? Where was the last structure move at this point? So I'm going to take this line here. Look at this here. There you have it. Look. This was the structure it broke on its way to completing the move. So that's the originating market structure when it was confirmed, right? You could use here if you want. I'm using here. It's the closest to the actual first confirmation, the first leg of the new market structure after it confirms. Wait for price to come back to that level. Once price comes back to that level, look for a sign that it's ready to move in the opposite direction again. So let's take this off. So at this level here, you're now back hunting it, because remember, you're trading the 4-hour chart, and you know that there's this level up here which we drew. See if we can find it. Where is it? Oh no, actually, so that's it there. Sorry. That actually no. So that sorry, I'm jumping ahead of myself. Here is what I'm talking about. Sorry. This, so here, remember, so it turned here. It starts to drop. We wait for it to come back down into the previous substantiating market structure break, which at this point is now here, right? So it went down here and blew up there. That's the point at which it started that upward move when it broke market structure in a 4-hour time frame at the confirmation. Wait for it to come back down to the same level. And if you want to refine it even further, we understand liquidity profiles by now. There's an order block here. That's the order block, a bullish order block there. So wait for price to come back down there. There we go. At that point, it comes back down there. So you're hunting a new short. You want to line it up with the fact that it, one, gives you a daily engulfing. So that's October last year. Let's go to the daily October last year. That's the line there. There's a daily engulfing there at the point at which it breaks through the daily, although this one just ran. This one on a daily chart didn't give you a chance to confirm it. That day just ran. So, but by the time it starts to go up past that point, you realize that it's running away. But even if you miss the chance because you're waiting for the daily engulfing, that's fine. It still confirms the principle. So you come back down there. And then at the level at which it comes back in there, no, we're looking at October, aren't we? October, where are you? Where's this chart now? I'm on the right chart. Oh, I'm in the wrong year. Okay, so 4-hour, October 2018. There we go. And so it comes back there. You're looking for a sign to go long, because remember, you know it's in a 4-hour reversal pattern, and I'm going to show you this when we start looking at trends. And at this point, you go back to the 1-hour chart. Remember, you got out because the 1-hour chart gave you a market structure the other way, in essence, a lower time frame reversal. So that's the level there. Just wait for a higher time frame another reversal back in sync in your direction on that lower time frame, which was here. This is the point at which it breaks structure on the 4 hour, right? Let's take the dividers off for now so you can see it. It comes back down there and it confirms that it's moving. There's a sharp reaction there. Again, that reaction is, so we always say add 2 to 3 pips. That's exactly 2.8 pips difference there. Catches it, shows you this overnight. A day opens up, it goes down a little bit, and then boom, it goes. And then you can ride it again until you get to this level there, which we already expected price would reach based on the 4 hour. Again, there's another market structure break there. Actually, that's the one. This is the one here. And it breaks it there. So if you got out there, again, your trade would have been, let's assume you got in here, either 8 pips, or if you wanted to be really safe, 30 pips still more than 3 to 1. And then he comes back down again. Now this is where it gets hairy. By the time it's done the first retracement and going back, it's a bit harder to time its movement. But on a 4 hour chart, you come back down. So that's this one here. It doesn't give anything obvious, although there is a liquidity profile here, which is the old low, old high, which now becomes a new. So this is a classic case of support or resistance becoming support and vice versa, we've taught. So if you see that happen there, and there's a 4 hour rejection, it comes back down to test it. You're in again at that point. So you go back down to the 1 hour, and then again, you wait for another market structure break on the 1 hour in your direction, which would have been here. This would have been the market structure break there. Price comes back and blows through it again and confirms there, and then you're in again. And the moment you get to the 4 hour big picture level, this one here, based on the old swing, you start looking for an excuse to come out. And at this point, when it happens at that point there, it goes through it and makes a market structure break there. You just sit down and you wait. Why? Because it's fulfilled the objective on the time frame you're trading. And what would you know? It then goes into a consolidation, as you can see. Because if you look at this on a 4 hour chart, I can bet you that looks like a consolidation. And there we are. It's a consolidation there. And then in this place, the consolidation rules apply. You drop down to a much lower time frame, say a 5-minute time frame, and you trade it from one end to the other, back up, back down, back up, back down. You don't start looking for anything fancy until it tells you that it's broken out of the consolidation pattern. And how does it break out of the consolidation pattern, the 4 hour time frame? By another substantiated market structure break. Look at that there. Now this is 4 hour. Purple. So you come out of a consolidation, it breaks market structure. It confirms it. Lower low, lower high, lower low, lower high. And so that's a confirmation. Right here is the confirmation here at this point that it is now broken market structure. It's been substantiated there. And then you reverse the process and then you start looking for excuses to short based on confirmations and levels and things of that nature. So you can see how when we're in a consolidation market condition, the rules we're applying are a lot different from the rules we're applying in a reversal condition. Now we're going to go to the next video to look at the trending condition, which is pretty much in between. So in between a consolidation, a reversal, and the next consolidation and reversal, you have a trend. And again, the rules we apply there are slightly different as well. Thank you for listening and watching. This is Israel. I hope this takes your trading to the next level. See you next time. Bye-bye.